up 33% in just 1 month, from a modular licensing giant to a new force building chips for the enterprise. ARM is teaming up with the blue giant, IBM, to launch a direct attack on Intel and AMD's home turf, but behind a staggering 1.41x divided by E and an extreme 7.5 to PEG. Is ARM becoming the core engine of AI computer and overinflated valuation stretched to its limits? With the launch of its first AGI CPU, is this a true turning point, or a high-stakes move that could put its own ecosystem at risk? Hey everyone, welcome to Stock Market Breakdown. ARM Holdings has been on a massive run. It's moving beyond mobile royalties, teaming up with IBM to enter enterprise data centers, from licensing to building AGI chips. ARM is transforming fast, but at 1.40x divided by E, can the story justify the hype? ARM is actively shedding its long-standing image as a mobile chip designer. Through deep collaboration with IBM, it aims to prove that its architecture is not only dominant in mobile and cloud environments, but also fully capable of handling mission-critical enterprise systems and data-intensive AI workloads. This marks a direct challenge to the x86 architecture that has dominated enterprise computing for decades. We're talking about systems that can go down for even a second. Bank clearing systems, telecom infrastructure. ARM used to be seen as not enterprise-grade, but this partnership with IBM effectively gives it a ticket into high-end enterprise markets. If this works, ARM ceiling disappears entirely. The key focus of this partnership is virtualization. It allows software built on ARM architecture to run seamlessly on IBM's existing infrastructure, including IBM Z systems and Linux Zone for large enterprise clients. This means they can adopt ARM without tearing down their existing systems, dramatically reducing migration costs and technical risk. This is a very smart move. You don't need to replace your servers, just upgrade the software layer, and you get ARM's efficiency benefits. IBM brings decades of enterprise trust and infrastructure, while ARM brings performance. This combination removes one of the biggest barriers for CEOs: reliability concerns with new architectures. ARM has officially announced it will move beyond architecture licensing and launch its own physical chip, products ARM AGI CPU. This marks a transition from a behind-the-scenes designer to a frontline manufacturer, directly competing in AI infrastructure and aiming to capture a larger share of industry profits. This is the biggest variable in the whole story. ARM used to be everyone's partner, now it's becoming a competitor. Why? Because licensing makes steady money, but selling chips unlocks much bigger profit potential. ARM is going after the full value of the AI chip stack. That shift completely changes how investors view its long-term earnings, sealing them. That's a major reason the stock has surged. As AI workloads become more complex and data center energy costs surge, ARM's power efficiency becomes a critical advantage. The partnership with IBM aims to deliver a balanced solution handling heavy AI training and inference, while meeting strict enterprise requirements for security, reliability, and uptime. In a world where power is the bottleneck, efficiency equals output. The compute race is really an energy race. x86 systems are powerful, but power consumption is their weakness. ARM was built with efficiency in mind. If it can now meet enterprise-level reliability standards, data centers facing power constraints have every reason to adopt it. More performance per watt, that's the real competitive edge. The future of enterprise computing won't be dominated by a single architecture. ARM and IBM are building a shared layer that allows software to move seamlessly across systems. Enterprises can choose between architectures based on cost, efficiency, and power consumption. This flexibility, avoiding vendor lock-in, is one of ARM's biggest ecosystem advantages in the AI era. Enterprises hate being locked into one vendor. ARM's strategy is smart. It's not forcing a full replacement of x86. It's giving companies options. That flexibility actually makes adoption easier. Once software can move seamlessly between ARM and IBM systems, ARM becomes an essential part of enterprise infrastructure. However, behind this powerful narrative lies an extreme valuation. ARM is currently trading around $175 per share, with a forward divided by E of 141 and a PEG ratio of 7.52. This suggests the market has already priced in 5 to 10 years of future growth. At this level, there is almost no margin for error. Any earnings miss or slowdown could trigger sharp volatility. A 1-for-1 X divided by E means you're not buying today's ARM, you're buying a future version that executes perfectly. A 7.5 to PEG tells you the stock price has far outpaced earnings growth. At this level, investors are betting that ARM's in-house chips can deliver NVIDIA-like upside. Market sentiment around ARM shifted dramatically in early 2026. At the end of 2025, investors were still concerned about rising R&D expenses and slow profit cycles, but with the March launch of the AGI CPU and the IBM partnership announcement, sentiment flipped almost instantly, driving a 33% surge in just 1 month. This reflects strong demand for AI-related investment opportunities. A 33% move in 1 month, that's not fundamentals changing, that's narrative shifting. The market suddenly believes ARM can evolve from a licensing company into a full chip supplier. That kind of sentiment reversal can be powerful and fast. Analysts currently maintain a moderate buy consensus, but acknowledge that upside may be limited by the high valuation. The key question now is no longer whether ARM's story is compelling, but whether its strategy, especially the IBM partnership and AGI chip rollout, can translate into real revenue over the next few quarters. In the end, ARM Holdings is making a bold identity, pushing into enterprise AI with AGI chips, but at $175. There's no room for error with IBM support. Can it break its MO label by 2026? Do you chase the story or wait for valuation to reset? Drop your thoughts and subscribe.